Welcome, everyone. Thank you so much for your continued interest in this workshop series, Retiring on Low Income. For those of you who don't know me, my name is Frances Morton Chang, and I am the Program Manager of the York Region Senior Strategy. Before I begin, I'd like to take a moment to read York Region's Land Acknowledgement. We feel it's very important when implementing and participating in a land acknowledgement that we are recognizing an enduring presence and resilience of Indigenous peoples in this area for time immemorial, and offering a reminder that we are all accountable to these relationships and have a part to play in reconciliation. We acknowledge that York Region is located on the traditional territory of many Indigenous peoples, including the Anishinaabe, Haudenosaunee, Huron-Wendat, and Métis peoples, and the treaty territories of the Haudenosaunee, Mississaugas of the Credit First Nation, and Williams Treaties First Nations. Today, this is home to many diverse Indigenous peoples, and we recognize their history, spirituality, culture, and stewardship of this land. We also acknowledge the Chippewas of Georgina Island First Nation as our closest First Nation community. I will now invite Julie Cassert, Director of Senior Services, to provide welcoming remarks and introductions.
Great. Thank you so much, Frances, and hello, everyone, and thank you so much for joining us. I just want to make sure to say thank you again one more time for your interest in this workshop series. Once again, my name is Julie Cassert. I'm the Director of Senior Services in the Community and Health Services Department at York Region. Hard to believe it, but this is our last week together, and I'm thrilled to welcome you back and welcome those who may be joining us for the first time. I also want to extend a warm welcome to our speaker, John Stapleton, social policy expert from Open Policy Ontario, who has generously shared his experience and expertise with us every week. We have had 4 fantastic sessions, and if you missed any of them, as Frances mentioned at the top of these sessions, have all been recorded, and once available, we will share the links in the recording to you by email. Let me get us started by introducing the York Region Senior Strategy team that you now see on your screen. Frances, who is moderating the session again today, and Senior Policy Analysts Judy and Michael are on hand, as well as the Data Analyst student, Angelina. As a brief reminder, in March 2024, Regional Council approved the 2024 to 2027 York Region Plan to support seniors. These sessions align with an action in our plan to communicate information on healthy aging, to raise awareness with seniors, caregivers, and staff to help seniors stay healthy and connected. It's important for you to understand the benefits available to seniors and how to access them, as this will support aging in the right place, connecting to services, and staying healthier longer. Today's session is about tax credits and benefits for seniors and people with disabilities. John will present about other tax credits and benefits for seniors, people with disabilities, and caregivers, including the Disability Tax Credit, the Canada Caregiver Credit, and the Home Accessibility Tax Credit. Again, as Frances noted, we have time at the end for your questions, answers, and clarifications. Next slide. By now, I'm sure you are all very familiar with our distinguished presenter, John Stapleton, who has done a fantastic job taking us through these sessions over the last 4 weeks. I will be providing, but do want to point out how honored we are to have John here to share his deep knowledge and understanding on each week of these weekly topics. John is the new Social Policy, Aging and Wellbeing Policy Fellow at the National Institute on Aging, in partnership with the School of Public Policy and Democratic Innovation at Toronto Metropolitan University. John is a social policy expert with over 30 years of experience, and many of these years he spent working in Ontario government at the Ministry of Community and Social Services. John has played a pivotal role in shaping social assistance policy and poverty reduction strategies, and is currently principal at his social policy consultancy, Open Policy Ontario. Through Open Policy Ontario, John provides training and resources to help individuals and organizations navigate retiring on low income. The goals of these weekly sessions have been to inform seniors, pre-seniors, and caregivers about retiring on low income, to be better prepared to live with low income in retirement. I feel we have accomplished this goal based on the fantastic participation, engagement, and excellent questions asked by our attendees. So for the last time, and without further ado, I turn it over to John to take us through his presentation.
Well, thank you very much, Julie, for your kind words and for your generous introduction. It's very much appreciated. And as we turn to the next slide, which is we'll get ourselves underway because there really is an awful lot to go through. Tax credits and information, why seniors and people with disabilities. As I started to inventory the various tax credits and various benefits for seniors, I realized that there was quite an overlap in terms of the specific benefits that are for people with disabilities in Canada, Ontario. In fact, I'll just give you a brief fact that is not in the slides, and that is the largest single group of people who receive the disability tax credit, in fact, are seniors, the largest single group. And so that overlap spawned the idea of not restricting this to both just to seniors, but to include people with disabilities, as it just made a lot of sense. Now, what I'm going to be doing for the next slightly less than 2 hours is doing something that what I think of as reading the dictionary to you or reading the encyclopedia. Basically, the value of the session is that we go through all the significant tax credits and benefits for, and especially the deductions, the refundable, non-refundable credits that are available. I do not cover every single credit. There are some tiny credits, small things that are for very specific populations, but I do go through all of the major credits that people might avail themselves of. So there doubtless will be credits and deductions, etc., that will not be of interest to everyone online, but at the same time, we will go through each one. So make sure that you pick up at the point where we get to the point of one that could materially affect your situation, and that's when you might be wanting to listen a bit closer. So let's get started. Next slide, please. Now, over the past weeks, for those of you who have been with us for the past weeks, I have made an analogy of the government and its income tax system to a grocery store or a drugstore. And the reason that I've done that is because the government's non-refundable credit system is very much like a store coupon. Now, why is it like a store coupon? Is because in a store coupon, there'll be a face value, $2 off, $5 off, $10 off. And the important thing about those coupons is that you, A, must buy the item that the coupon is associated with. You cannot just go in and redeem a coupon for cash at a cashier. They'll tell you that you have to buy the product, and everybody knows that. So in the government store, in order to have a non-refundable credit be of value to you, you must be in a situation where you owe taxes, because a non-refundable credit can only be used to reduce taxes payable, and it can't reduce them beyond zero. It'll either reduce them to zero, or for somebody who pays a lot of tax, it'll create an amount that that will lower your taxes. And it's the same for rich and poor. So just as you know, if you were in a lineup at a drugstore or a grocery store, you know that people holding the same coupon with the same dollar amount on it are going to get the same money off their coupon. So that's why, so every time you see the term non-refundable tax credit, you should be thinking coupon off my taxes. That's quite different from a refundable tax credit. And a refundable tax credit is, if you're in a store, is like a gift card. And a refundable credit can return a payment to taxpayers even when no income tax has been paid. So in other words, refundable credits are very good for low-income seniors and people with disabilities because it doesn't depend on you owing taxes, whereas a non-refundable tax credit does depend on you owing taxes. So it's like a gift card. And a deduction in many ways is like a variable coupon. A deduction reduces the amount of taxable income you have. So if you have a $10,000 deduction for childcare or for an RRSP, then if you made $50,000 a year, well, it's going to lower your income that the government sees to 40,000. So that's what it does. It doesn't lower taxes directly. It lowers your income. And of course, then you will get the tax advantage of having lower income, and you would get a refund in that way. We only have two major deductions in Canada, although I'll get into some of the more minor ones in this presentation because they're important. But the two big ones are the RRSP deduction and the child care deduction. A deduction lowers net income, making it easier to qualify for programs such as GIS and the GAINS program, and deductions can also work for people receiving social assistance. And again, deductions lower your income tax for tax purposes. So if we just circle back to the government store for a moment, how does a deduction differ from a non-refundable credit is if you were to take your coupon up to the cashier and present your coupon, say for $10, the cashier, if it was like a deduction, the cashier would have to look at you and say, I don't know the value of this coupon until you tell me your tax rate. How much money did you make last year? If you tell me how much money you made last year, and I got a little calculator here, I can tell you how much the coupon is worth. So let's say, for instance, you have somebody who's making $100,000 per year and has a $10,000 deduction for RRSP, and then you have somebody making $50,000 a year and has the same $10,000 deduction, and then someone whose taxable income is zero, they're not paying any tax, let's say at about $10,000 a year, then and not paying any taxes, then their tax rate is zero. So the deduction for the $100,000 earner might be worth $5,000. The deduction for the $50,000 earner might be $2,000. And of course, the deduction for the low-income person who doesn't pay tax is zero, and very much like handing in a coupon to a cashier and then not buying anything, because it lowers your income, but you're already not paying tax. So this is what I covered in the other sessions, and so I use that heavily in this presentation. So let's go on to the next slide, please. So now we're going to go through a list of coupons that are available to seniors. They are in the tax system. They will be called non-refundable credits, but for the purposes of this presentation, we'll think of them as coupons off your taxes. So let's go to the next slide, please. So first of all, there's an amount. You'll know that people who make very little money, in fact, do not pay any taxes at all. So in fact, if you were to, and I'll give the anecdote of meeting a young woman who was from Africa in one of my presentations in real life some years ago, who was crying and said that, and when we asked what was wrong, she said that she had made about $10,000 to $12,000 a year. That's all she had earned, and she'd earned that for about 5 or 6 years, and now she thought she was in trouble because she had not filed her income taxes over that period of time. So I was able at that point to put on a big smile and saying, well, if you only made $10,000 to $12,000 a year, your basic personal credit amount would cover that amount, which is $15,000. And generally speaking, although that credit is $15,000, it's about $17,500 before you start really owing any money in the tax system, because some other tax forgiveness that's on the file. And of course, there's different tax thresholds for the federal government than the provincial government, but the federal one is $15,705 for 2024. So if you're earned under that non-refundable credit, then of course you're not going to owe any tax in the first place. The reason I smiled at the young woman was because I realized that once she went into a social services agency and was able to file all her back taxes, then she was going to get a series of gift cards. And in her case, because she had a child, she was going to get the Canada Child Benefit. She was going to get her GST credits, her Trillium credits. So a variety of different credits that she would get in that case. So it's always a good idea to file a tax return anyways, even if you don't owe them any money. And I've said often enough, I think that if I had $1 for every person who had told me in these sessions over the years that I didn't file a tax return because I didn't owe them anything. Yes, but they owe you. There is a shelf, a personal shelf in Ottawa, and that personal virtual shelf, the federal government will deposit gift cards in your name in that shelf or that cubbyhole. And if you don't, and the way you get those gift cards is to file a tax return. And if you don't file a return, then the gift cards simply sit there. They don't disappear. And as a result, and this is an important point, that you can file back for many years of taxes and get your the various different credits, like the Trillium, like the Canada Child Benefit, the Canada Workers Benefit, the Canada Child Benefit, which is a big one, for all those years that you did not file. Some people will believe, in fact, that they will owe more money than the government will owe them. I think in the last 14 years, I've met one person where that was the case, and so it's very rare that the amount that you would owe the federal government would in fact be higher than the value of those gift cards. So yeah, I think you can safely say that everybody should file a return, and especially the lower income you are, the more of those gift cards you're going to get back. Next slide, please. So there's a federal age amount, and that's why people 65 years of age or older at the end of a tax year may be able to claim up to $7,898. It's going to be $8,790 for 2024, and for that age amount. But that credit, that non-refundable credit, that coupon is reduced by 15% of net income over $44,000 for this current year. For the year, of course, all of us will be filing our 2024 returns in 2025. And of course, this may reduce tax owing to zero. And the lucky part here is that any unclaimed amount can be transferred to a spouse, but it can only be transferred to a spouse, which means somebody to whom you're legally married or a common law spouse. So it works that way. Now, when you look at these numbers, when you see, for example, a credit of $8,790, or you're going to see a credit of for 2024, does that mean you're going to get $8,790 back? Well, the answer to that is no. The value of the credit is usually a small percentage. In other words, in terms of the actual amount of money that you will save. And we'll see that throughout all these non-refundable credits. What the government usually does is actually refund or pay back to you or take the money off your taxes at the lowest tax rate, and does that for rich and poor, for people with higher tax rates and lower tax rate. So that what it does is equalize the value of the credit to all tax-paying individuals, regardless of their income, high or low. Of course, a deduction doesn't work like that, because a deduction works as the higher the income you get. If you're lowering your income with the deduction, the value of the deduction is going to be higher for the person making more money than the person making less money, as we saw with the RRSP example that I just used a couple of minutes ago. The higher paying tax individual is going to see an amount come off their taxes that's higher than a lower paying individual. And of course, for someone who pays nothing at all, the value of non-refundable credits and all deductions is zero. And again, I'll just take a moment to say that we see a lot of people coming into the various tax clinics who receive ODSP, Ontario Works, and some seniors who will bring in lots of receipts for minor charitable donations, for transit, for a variety of different things, not realizing that if they pay no tax, the value of the coupon is zero. And in other parts of this series, I've made the point that for low-income people, actually investing in RRSPs makes little sense, because the value of the deduction is either very low or nothing, and they're much better off being in tax-free savings account. Next slide, please. So there's a spousal amount credit. You might have in the past heard about spouses being tax deductible. We have not had a tax deduction for a spousal since 1986. So that's 14 and 20. We haven't had one for 38 years. But there is a spousal amount non-refundable credit. And so you may be able to claim a spousal credit if your spouse earns less than $15,705 in 2024. The amount, so let's say someone made $10,000 as a spouse in 2024, then a non-refundable credit would be transferable to the other spouse of the difference between how much money they made, say $10,000, and the $15,705. That's allowable. So most people, when you think of minimum wage full-time being about $33,000 gross, most people don't qualify unless a spouse is at home and not earning and not receiving any form of compensation. Taxable compensation is the point at which a spousal credit can come into play. So sometimes it's better to minimize the amount of income earned by your spouse to maximize the spousal credit, especially if a spouse is making very little money or has no income, because then the transferable amount can come off the taxes of the higher earning spouse. And sometimes it's better to transfer more of the higher income spouse income to the lower income spouse. I'm not going to get into that. I'm just going to say that that's at the point where you want to talk to a professional tax preparer at your to talk to somebody. And remember, I usually recommend that the tax preparer, if you're going to go to a paid professional, is to talk to an independent financial advisor, because once you get an independent financial advisor, that person is working for you as opposed to working for the firm like the bank or an investment house of various sort, where they're usually, when they're working for them, they have to make them money, as opposed to an independent who you would pay them, but they are at least working for you. So I always try to promote the independence. Of course, if you do not wish to or can't pay for tax advice, then you can always go to the various different community-based tax preparers and clinics of various sorts that will help you with your taxes. Next slide, please. So transferring unused tax credits. Some personal tax credits can be transferred between spouses if one spouse does not have enough taxable income to use them. And in this case, there are three of the, I think there's maybe some other smaller ones, but these are the most important ones. The age credit is transferable. The pension credit is transferable, and the disability tax credit. And remember, I said the largest single group of people who actually get the disability tax credit are seniors. So those are all transferable. Again, if you don't have enough taxable income to use them, remember, if you have already reduced your taxable income to zero, then any value of a credit can go to the other spouse, but it specifically can only go in these three. Next slide, please. Now, there is something called a pension credit, and I actually I just made a passing allusion to it in the other sessions. But in the case of the Canada Pension Plan, Old Age Security, and the Guaranteed Income Supplement, a lump sum RRSP withdrawals all do not qualify as pension income for the pension credit or pension splitting. So in other words, but taxpayers 65 years of age or older can claim a tax credit on the first $2,000 in annual eligible pension income. So if you got a pension from your employer, as opposed to the public ones or RSP withdrawals, if you have a pension from a company pension or a government pension or from your employer, you can claim a non-refundable, so in other words, a coupon on the first $2,000 in annual eligible pension income, payments from a registered pension plan available at any age, not just after 65, payments from a registered lifetime annuity, and payments from a RIF. You'll remember that at age 71, all RRSPs in Canada turn into registered retirement income funds. What happens when they go from an RRSP to an RRIF at age 71 is that amounts of the money in the RIF must be taken out and provided to you. And when they get provided to you, two things happen. One is it's taxable, so you have to pay tax on it. And the second thing is that if you have a program, if you're eligible for a program like the Guaranteed Income Supplement, then it will reduce the Guaranteed Income Supplement. So what I always try to do is have people to the extent possible where they have savings to save money in a tax-free savings account, as opposed to the RRSP and the RIF, because then they won't suffer any of the clawbacks and they won't be taxed on the money taken out. So the TFSA is always best for low-income people. I did give an exception to that, is where people could get between 65 and 71 people who put money into an RRSP can increase the amount of GIS they receive, but that was covered in the previous presentation. And also this $2,000 tax credit on eligible pension income, a coupon, applies to any interest paid as part of a non-registered annuity, can qualify for that $2,000. And again, the amount that you actually get off your taxes would be around 15% of the 2,000. So the actual value in your pocket is going to be in the $300 range. Next slide, please. And if you're not receiving $2,000 of eligible pension income, you can create additional eligible pension income. And this is an area of complexity that I did not get into the regular series of on low income in weeks 1 through 4, is converting all or part of an RRSP into a life annuity or RIF. Withdraw $2,000 per year of your RRSP and put it into a RIF earlier than is required. In other words, the year that you turn 71, you could do that before reaching age 71. So that's something to think about if you need it. And it's at this point, I'm not going to get into the complexity of that. And again, this is something you should be bringing up with whoever it is who does your taxes. If it is in the person in the mirror, meaning you, then you should learn more about it. If it's a relative, make sure that they understand the rules surrounding that. But if it's a paid tax preparer or a volunteer at a community center, they will know about the ins and outs of if you have eligible pension income. The reason I include it here in this is that most people who are low income, those who are receiving GIS, most of them will not have an eligible pension in the first place because it's a pension outside of the various government sources of pension. So I'm mentioning it here as I'm covering this for persons of any income. If you can do a pension income split with your spouse, then each of you may be able to claim the pension income credit. So if you are a person who has a spouse and living with your spouse, and you can do a pension income split, and that's, again, something I do not get into in detail. It's something that you would get into with your tax advisor. If your tax advisor is a software program like TurboTax or any of the other programs, they will provide you with their computer program inside the software will provide you with the optimum split of a pension. But again, this is a situation where both spouses have a pension or one spouse has a pension, then you can do that and possibly also get this pension credit. So that's something that, generally speaking, modest to higher income people as opposed to low income. Next slide, please. Okay, there's a non-refundable credit called the medical expense credit. It's a bit complicated, so I'm going to go through the basics of it, but I'm not going to get into a lot of the detail that can come in the questions and answers, because there is a lot of detail to this medical expense credit. One thing I will say is that there's an awful lot of people who attempt to get the medical expense credit and then find out that the amount of paperwork they have to do and the amount of receipts and everything else that they have to keep, that it's not worth their while. So that's something to stay into account, but don't decide it's not worthwhile on your own. Collect the information and the receipts and then see if it's worthwhile to you. So it allows you to claim a credit for medical expenses that are more than 3% of your total income or all amounts over $2,759 in 2024. So it's the lower of the two. So it's usually best for the lower income spouse to claim both spouses' amounts. Why? Because you are claiming on an amount over a certain amount, like the 2,759. So if your 3% of your income is higher than 2,759, then you're going to get less of a credit. So you may not have had enough medical expenses to claim the credit in the past. Don't forget about it once your medical expenses start to increase. And so if you're getting, for example, glasses, hearing aids, especially some dental work, all now cost a lot of money, and they can be, and often one of the things that you can do is think about having a lot of the work done in the same 12-month period within a tax year, over or straddling a tax year, so that you can claim all those expenses. So keep all receipts through the year. Get in the habit of adding them up to see if you could qualify for each year. So if you only got a couple of thousand, it's not going to do you any good because it has to be more than 3% of your total income or the minimum of 2,759. Federal and provincial medical expenses you claim have to cover the same 12-month period ending in, now in this case, it would be ending in 2024. So it's not necessarily a calendar year and must be expenses no one has claimed on a previous return, like 21, 22, etc. So it's important you do it. One trick that I've noticed is you do have a medical plan either through privately or through your work of any sort. One of the things that most people do is they submit all their medical expenses. But I can tell you that the Canada Life software, just as an example, you can simply go in and look up your medical expenses, and they tell you what they've paid for and what they haven't paid for. So it's a tip to take that amount that they didn't pay, and that would be a good source of the amount. So in other words, you don't have to put it down on pen and paper yourself, except for those amounts that you didn't claim. But it's just a way of thinking about it. And most of the big insurers have that sort of accounting that goes along with that. Next slide, please. So the medical expense credit, and of course, this is not something that you would have submitted to your insurance if you have either a private or a public plan. That is, transportation costs are allowed if you must travel a distance in excess of 40 kilometers to receive medical treatment. But the catch is that medical treatment that is not available closer to home. Now, some people will choose because they want to go to a particular medical treatment and therefore will try to claim the kilometerage or the mileage. And of course, they'll be told by CRA that hey, that was, you could have got that treatment anywhere and you didn't need to travel for it. So you got to be really careful with it. If the patient cannot travel alone, travel costs will also be allowed for one additional person, not two. So it's important to know. And your meal costs are allowed if you must travel at least 80 kilometers, so that's about 50 miles, to receive medical treatment. And again, you have to, it's obligatory that you have to travel that amount. So it's usually more amenable to people who live in more rural parts of the province, where they must get the treatment in the city. For people who live in a downtown area of a city or in a large built-up area are going to have less access to this. If the patient cannot travel alone, meal costs will be allowed for one additional person. Next slide, please. So here's some examples. I'm not going to go through what the examples are, but for example, someone saying my parents need to go to London Health Science Centre once a month for tests and specialists. The expenses add up to almost $4,000. And of course, we say that the person lived further away than the kilometers that are necessary. We adapted a van to be able to take them in. My parents' employment income is $6,000. What would we need to consider on our tax return? Sometimes they both go. Sometimes I'll go with one or the other. We have a health plan, but it doesn't cover everything. Well, what can we claim? So this is the sort of situation that someone would be in where they claim those expenses, and what we just explained in terms of meal and kilometers applies to this. Next slide, please. Another example would be someone saying, my husband has a physical impairment. I've been taking time off from work to take him to appointments and help with his personal needs. His doctor certified in writing that he is dependent on me for personal needs because of his impairment. What can we claim? Well, you wouldn't get the medical expense in this particular case. You would be using the different tax credits that we're going to get into as we go through this odyssey that we're doing in terms of the dictionary and encyclopedia of Canadian tax credits. Next slide, please. So there is also, in addition to the federal credit, and again, it's a coupon. We haven't got into gift cards yet, and we haven't got into deductions, which are variable coupons. We're still on the flat coupon. So keep thinking in your mind that we're talking about like store coupons with a face value on them. The Ontario medical expenses you claim are the same as you claim for the federal, except for if the amount you claim for medical expenses in your federal Schedule 1. Now that's what's inside TurboTax or any of the software, and any tax preparer is going to know the Schedule 1 includes an amount for attendant care expenses that was limited to $10,000 or $20,000 in the year of death. The maximum Ontario claim for attendant care is 13,844 or 27,687 of the year of death. And remember, you claim that amount. That's not the amount that you get back. You get a percentage on that. About 15% would be the amount that would actually come off your tax bill. And remember, if you don't have a tax bill because you're low income, then it would not have a value for you. So the maximum Ontario claim for the cost of a van adapted for transporting a patient who requires the use of a wheelchair it's not just someone who uses a wheelchair, but they must require it, but they can get an additional Ontario credit. Again, a coupon of 6,922, but again, the value of that coupon is going to be worth about 15% because it's depending on the tax rate. And the maximum Ontario claim for moving expenses for a patient's move to a more accessible dwelling is a coupon for $2,769, the value of which will be about 15% of that. Next slide, please. Then there is something called the Home Accessibility Tax Credit, or HATC. Once again, it's a coupon. So we have the federal non-refundable credit here for seniors 65 and older, or people with disabilities. And here you can see again why this presentation includes both people with disabilities and seniors, and or both, who made changes to their home to improve the quality of their life. So for 22 and subsequent tax years, the credit allows you to claim $20,000 in home improvement expenses to them. And again, up to 15% of them, $3,000, comes back to you as a credit. So you're starting to see how most non-refundable credits, in terms of their value, in other words, what money is going into your pocket, is going to be about 15% of the credit. I notice a lot of people will say, well, I just got a $6,000 tax credit, and their thought balloon will be that I'm going to get $6,000 off my taxes. No, what you're going to get is a percentage, usually 15% of that value of the non-refundable credit. And relatives who support a related senior may also be eligible for this credit. And among the expenses are wheelchair ramps, walk-in bathtubs, wheel-in showers, door widening, non-slip bathroom flooring, ergonomics, easy to use door locks, hand-free water taps, and motion sensor lights. Now, who is the person that is going to be the person who is recommending all of this? In most cases, it's going to be what's called an occupational therapist. An occupational therapist is not someone who gives you therapy about your job. It's about how your home is configured, and an occupational therapist will come in, watch your mobility or the mobility of a loved one, and then start to talk about the various different aids that can be installed in the house. And so that's how you would usually come across the home accessibility tax credit that would be confirmed by the various lists that an occupational therapist would provide. Next slide, please. And here we come to one of the big ones, the charitable donation tax credit, something I think that we've all seen. You get it from websites. We've had Giving Tuesday. We all get in our email all the time various calls for us to provide charities with funds to help them, and they always will tell you that you are going to get a tax credit. Some will still tell you that you can get a tax deductible credit, that you get a tax deduction. That is simply not true. There are no more deductions in Canada. There haven't been for many, many years. Any form of deduction. It is a non-refundable credit. Okay, and here we have 15% again. So if we were to take the amount up to $200, you get a 15% credit on all your charitable donations up to $200. So what's that mean? It means you're going to get $30 in your pocket off your taxes. And then I guess arguably one could say that richer people, because they get 29% on the remainder. So if they gave $1,000, then they get a 29% credit on the $800 above the first $200. So for people who give more, get more, and people who get, but it still remains a non-refundable credit, like a coupon, because the coupon values are fixed. Whereas for a deduction, the number is not fixed because your tax rate determines the amount and the value of the credit. So if the donor's net income is greater than $200,000, the tax credit is 33% on donations in excess of the $200. And then there is, so this one covers those people who are actually able to give more. Sometimes we have people that are lower income who give large donations of stuff, especially when they have an inheritance. We see this, but they should know that the value of the tax credit is going to be very low or nothing, because the tax credit is always money off the taxes you owe. All right. And so that has to really sink into the people that you're either yourself or people that you're talking to, that it can't provide any money in your pocket that relates to money that is below the amount that you need to pay in taxes. So if your tax rate is zero, if you're paying zero in taxes, the value of the deduction is also zero. So for people who give more money than, and especially where their income is greater than 200,000, the 33% of the donations in excess of 200 on the lesser of the amount of the donation, the person's net income greater than 200,000, non-refundable credit, but unused amounts that can be carried forward for up to 5 years and cannot be carried back except to the year of death, and max contributions eligible cannot equal more than 75% of net income. So this is advantageous for higher income spouse to claim both spouses' donation. But the point of all these bullet points is to say, can someone actually, with a very high income, give so much money that they actually will owe no taxes only in very specific situations would that happen. The government is trying to make sure that people are not able to reduce their tax liability to zero through charitable donations. Next slide, please. So let's now get into the disability tax credit. The disability tax credit is an amount of $9,872 in 2024. And I've just made a note to myself here where the actual value of that credit is 15%. So in 2023, well, the credit, so you just multiply the 9,872 times 15%, which is going to get you about, $1,400 to $1,500. So it's at the 15% rate in terms of the actual money in your pocket if you owed at least $1,500 in taxes. So in other words, let's say you applied for and received and were eligible for the disability tax credit. The most amount of money that you can get off your taxes is about $1,500. And that $1,500, if you reduce your tax credit to zero, there is some transference here, and we'll get into that. So you have to complete this form T2201, the tax certificate, and that CRA has revised this many times, and they are currently revising it again to try to make it easier. There was a time when you had to have a doctor fill out the I'll call it the DTC, Disability Tax Credit application. But now you can have a nurse practitioner fill out the disability tax credit certificate. And the certificate describes the nature of the impairment and the manner in which impairments has affected ability to perform an activity of daily life, activity of daily living, and the expected duration. It must be a continuous period of at least 12 months. Now, this is important. One of the reasons, it's not a disability definition that relates to employment. It is a disability determination that relates to your condition and your activities of daily life. So whereas the CPP disability tax, CPP disability payments totally look at your ability that your disablement has created the situation that you can no longer work. That's not how the DTC work. And that's why it's so available to so many seniors, because their activities of daily life in many cases have been diminished, especially as they get into their advanced senior years. Next slide, please. So the DTC, the disability tax credit, there's three criteria for eligibility. You are blind, you're legally blind. You're markedly restricted in ability to perform a basic activity of daily living, or you would be markedly restricted were it not for extensive therapy to sustain a vital function. So you will find that, for example, the people who have kidney dialysis will mostly qualify for the disability tax credit, even though the dialysis may raise their activity levels to a point that wouldn't otherwise restrict their daily living, but the dialysis itself, of course, does that. And they usually look at restricting it by about 90%. So if somebody has some sight, if they have some hearing, they look at various different tests of being able to walk various distances, etc. Next slide, please. So it relates to these 7 different activities of daily living: perceiving, thinking, and remembering. That would relate, of course, to dementia and cognitive decline. Speaking, if you're unable to speak, if you're able to unhear, you can't really get around walking, that you cannot dress yourself, feed yourself, or have difficulty with your gastric and bowel system. But you may also qualify if you have multiple systems together, which of course, this is what you'll also find with seniors, having an impact similar to a severe restriction at any one. So you might have you might be hard of hearing, but it wouldn't be enough to get you the disability tax credit. Or you might have some trouble with taking longer to dress yourself or feed yourself. But when you put them all together, the multiple symptoms would be sufficient to meet the disability tax credit definition. Next slide, please. Here we go. So here we have the individual with severe and prolonged impairment. So those that have those impairments do not need to prove a marked restriction in a basic activity of disability of daily living if they can prove that they would have such a restriction if they were not receiving extensive therapy like dialysis, therapy that's required to be administered at least 3 times a week for the total duration not less than 14 hours per week, and if one cannot reasonably be expected to be of significant benefits who are so impaired. Next slide, please. So speak to a professional taxpayer in terms of the disability tax credit is often a good thing to do, especially if your claim is denied. Now, I'm just going to explain for a couple of minutes that sometimes you will see advertisements that could be on a billboard, on the side of a bus, perhaps on television, perhaps hear it on radio or a program or in literature that said that that you might be owed a very, very large amount on the disability tax credit. Come and see us and we will work it out. Well, a lot of those private firms that do this, they will have their own doctors or own nurse practitioners who would then come and visit you. And then what they're really looking for are people who have been disabled for a long period of time, because what it allows them to do is to refile your tax return for many, many years. You see what you can do in terms of any tax credits. You can go back a long way. And so what they're looking for is people that say, where the nurse practitioner could say, you have had these disabilities for 10, 12, 15, 20 years. So they would do their tax return. What those private operators do is then take a contingency fee. Now, I'm not going to comment one way or the other on private services that do this. They take a certain percentage of contingency. For some people, who are going to have real trouble with the application and navigation process for it, then that's something that might be desirable for them. But just know that when you do that, that they're going to take a fee. The private operators will turn you down if you've only recently became disabled, for example, because you might only qualify for the disability tax credit for a year or so. I know that there was also the situation where the federal government was trying to shut down the private operators who are getting contingency fees, but at this time, I think that situation has been stayed, or at least it had been for a while, such that they are still operating. Again, they're looking for situations where somebody's been disabled for a long period of time, so that the contingency fee makes it worth their while. So you can transfer any unused credits or credits you're unable to use due to low income. So in other words, you can't use a disability tax credit. They can be transferred to a supporting person. And of course, the supporting person is somebody who's going to be paying taxes. There's no sense transferring that. It's the same as with a store coupon. If you have a $7 coupon for a particular item, it's the same as going to somebody else, a friend or a relative, and saying, hey, can you use this coupon? Well, if they can't use it, they're not going to buy the item, then the coupon is worthless. So that's the same thing here, that only transfer it to a person who is paying taxes, positive taxes. So it would reduce it would reduce their tax liability so that they would have money in their pocket. So the supporting person could be a spouse, parent, grandparent, child, grandchild, brother, sister, aunt, uncle, niece, or nephew. And this applies also to a provincial amount too. You may not claim the disability tax credit if you claim attendant care or nursing home expenses as a medical expense, other than certain attendant care costs not exceeding $10,000. So I'm not going to get heavily into this as we're trying to get through everything in a couple of hours. But if that is your situation, where you're also claiming attendant care and the disability tax credit, then you need to talk to a knowledgeable person about that situation. Sometimes it can be a medical professional, or sometimes it can also be your financial advisor. Or if you don't have the money for financial advice, that you can ask for somebody who's in a tax clinic, for example. Next slide, please. So the Canada Caregiver has replaced what used to be called the infirm dependent amount, caregiver amount, and family caregiver amount. These are phrases that might be in your memory in terms of what this was called at one time, but this is now the caregiver credit. So for the last 7 years, since the federal budget eliminated the 3 then existing caregiver credits and then replaced by the Canada Caregiver credit. And here we have I don't have the amounts for 2024 there. I assure you that I did look them up and didn't find them readily. But you can see that it was about $8,000 in 2023 and $2,500 in 2023. The higher amount, of course, for infirm dependents who are parents, grandparents, siblings, aunts, uncles, nieces, and the lower amount for an infirm dependent spouse for whom the individual claims the spouse or common law partner amount, and infirm dependent for whom the individual claims an eligible dependent credit. So you can start to get pretty complex, and that gets complicated in terms of the distance in your relationship from the person where you're claiming it. And again, the amount you're actually going to get in dollars in your pocket off your taxes, and only in those situations where you do pay taxes, is going to be 15 cents on the dollar. Next slide, please. Other features of the Canada Caregiver credit that differ from the old credits: it's reduced dollar for dollar by the dependent's net income. So if they're having, income that they report on their taxes, 19,990, to almost 20,000 in 2020 for 2024 that will be claimed next year. That credit. So it's only going to go to lower income people. The dependent will not be required to live with the caregiver in order for the caregiver to claim the new credit, and it's not available for non-infirm. So if you just take care of your for your grandmother, grandfather, it's not just for the regular caring that would go on in a situation like that. It's a credit for those specific duties that would relate to someone being disabled. Next slide, please. So only one Canada Caregiver credit is available for each infirm dependent, but it could be shared by multiple caregivers who support the same dependent, as long as the claim does not exceed the maximum that's allowable for one. If someone has claimed a spousal amount of eligible dependent amount for infirm dependent, only that person can claim the Canada Caregiver credit for that dependent, and an individual cannot claim the Canada Caregiver credit for a person if the individual is required to pay a support amount for that person to their former spouse or common law partner. What the government is really trying to do is trying to give people a break in terms of the tax liability, because it is a non-refundable credit. But at the same time, they're trying to stay away from situations that we might call normal care that does not relate to extraordinary situations. Next slide, please. And another note that a caregiver amount for in-home care of your parent or grandparent who is not infirm is no longer available. So just taking care and helping out with grandma or grandpa is not going to be, is not allowable. But if you did not have a spouse, or if you were not living with or supported or being supported by a spouse, you may be able to claim the amount for an eligible dependent in respect of your parent or grandparent. Okay. If you're living as a single person and you take care of them, and that can be allowable. So one positive addition is you're no longer required to live with the dependent to claim this credit. So you can live apart from them and do it. In the old days, you used to have to be living with them. Next slide, please. So now we have time for a quick break. We're about halfway through.
So I see it's at 2:15.
Yep.
So those were teasers. We need to come back. But if people didn't go off to use a personal moment, you may have heard a bit of a teaser there.
So so everyone knows that gift cards are very, very different from coupons. And I know that when I go to the store, I'd much rather have a gift card for something than a coupon, because a coupon is very restricted and it's only going to give me a certain amount of money, and it only applies to when to the particular item that I'm talking about. And why that's so important is that gift cards usually can buy anything. And of course, the same is true for government gift cards. You can buy anything in the store, except maybe tobacco products and lottery tickets. But generally speaking, gift cards can be used for anything. And so when you should be, I know that I am, and I know the people I talk to perk up when they hear something as a refundable credit, because it means that this is something I can get regardless of the taxes I pay. And of course, those credits, like the Trillium, which people get quarterly, is entirely outside of your usual tax refund. And something like the climate action payment is another example of gift card. And also the political contribution. I don't get into that, but political contributions are refundable credits at various different levels of government. If you pay for, help a political party, you're going to get money back regardless of whether you pay tax or not. And that's the difference. So let's move on to the gift cards that seniors get, and people with disabilities. Next slide, please. So there's a refundable medical expense supplement. And so, in other words, it is a gift card from the government. It's available to low-income individuals who have paid medical expenses or disability support expenses. And to be eligible for the supplement, the individual must have employment or self-employment income that exceeds, I got the number there for 3,841 for 2023. And for the maximum supplement is the lesser of, and here's the gift card, $1,316 or 25% of both medical expenses and disability support expenses. And I haven't been able to find, I find updates to all of these things, but I want to make sure that the site that I'm looking at is credible and has all the up to date. So I'm just giving you this as an example. So refundable credit, that's real money. So that's going into your pocket. It's not just some percentage of another figure that will only go to you to reduce your taxes. So this would go to lower income people who may not pay tax at all. So it's a special medical expense supplement to help people out who don't pay taxes. That's why you would have a refundable credit in the first place. Next slide, please. The Canada Workers Benefit. The Canada Workers Benefit is a special refundable credit, like it's a gift card coming from the government, regardless of whether you could be working at, say, a low amount. I gave an example of that in the previous hour. About people who may not be paying tax in the first place, but they will still get money. So it's like a supplement to the working poor, if you will. And the Canada Worker Benefit is for low-income individuals and families who earned income from employment or a business. And there's a basic amount, but it does have a disability supplement on top of the basic Canada Workers Benefit. And you may be able to claim a Canada Workers Benefit disability supplement if you are eligible for the disability credit and you had working income in the year. So this is a really important point that's different from all the other points that I've made. And that is sometimes your refundable credit, in other words, your gift card, is contingent upon you having receipt of a non-refundable credit. So that is, so you can only get the gift card if you qualified for the, if you qualify for the coupon. So the closest that I can come to in my own mind is, and this is not a plug for Shoppers Drug Mart, but sometimes seniors can go in and they get 20% off on the Thursday. So that's money off their payment. Remember, they have to pay for the goods that they buy, but they get 20% off. So it's money that comes off the money that's paid. But every so often, and a couple of weeks ago, they had this where that if you bought $50 worth of stuff at Shoppers, then they would give the senior an extra $10 card. So, and that was good for money off anything that you bought. So any of those situations that you find in the stores are good examples of what this is. So you qualify for the non-refundable credit called the disability tax credit. And then that allows you to receive the extra gift card from the government through the Canada Workers Benefit. So it's a case of a non-refundable credit resulting in a refundable credit or a gift card from government. The same is true for something called the RDSP, the Registered Disability Savings Plan, that you must have the qualification for the disability tax credit before the age of 49. And then you could get something called the Registered Disability Savings Plan. And so this is a positive amount that the government pays to you throughout the rest of it can be payable to you over the age of 65, but it's a positive amount that's paid based on your qualification for a coupon. So if that analogy can work for you, it's something that applies to the Canada Worker Benefit Disability Supplement and the RDSP, Registered Disability Savings Plans for people with disabilities who are younger than age 49. Next slide, please. Then there is the GST or HST credit. So many of you will remember that we got the GST credit back in 1992 when we first did the brought the goods and services tax in, which is a different kind of tax, of course, that we pay on when we purchase things. Generally, most all things that we buy in life will have the GST on them. So this is a way of giving some of that money back, and it's a tax-free quarterly payment that helps offset all or part of the GST that you paid. So to receive this credit, you must file a return every year, even if you did not receive any income. So go back to the person saying, I don't owe them anything, so I'm not applying. Well, you're missing out on this credit that is going to go into your virtual file or cubbyhole or shelf in Ottawa, these credits will be mounted, these gift cards will be mounting up if you don't apply for them. And so how do I apply for them? I file a tax return. If you have a spouse, only one of you can receive the credit, and the credit is paid to the person whose return is assessed first by CRA. Okay, next slide, please. There's the Ontario Trillium Benefit, sometimes called OTB, but the Trillium Benefit takes a variety of refundable credits that used to be available through the Ontario government and put them all into one benefit that they call the Trillium Benefit. It is a refundable credit, therefore it is a gift card to individual tax filers, and they receive this benefit as a gift card. In other words, even if you don't pay tax and you're not liable for tax, this is money that was still paying. So in other words, it's a way to think of it is to say the government is using the tax system to mount a program to pay people income security benefits. So it includes the Ontario sales tax credit. You don't need to apply for that. CRA will tell you if you're eligible. The Ontario and Energy Property Tax Credits, you must apply for this. Apply if you qualify for either or parts of it. And the Northern Ontario Energy Credit, which you must apply for. Now remember, you apply for them on your tax form, but if you have some tax software like TurboTax or any of the other big ones, you will be prompted in the software to put in the answers that they are looking for. They'll ask you what your property tax is, what your rent is, for example. And as you go through the tax software, most tax software will prompt you, and if you don't put in the amounts they need to get the credits, they will keep prompting you. And then at the point where you're trying to file your return electronically, it may not let you file it until you've actually put an answer in there. So they prompt you aggressively so that you will get this money. You must be eligible for at least one of these above bullets here to get the Ontario Trillium Benefit. Next slide, please. Then there's the Ontario Senior Homeowners Property Tax Grant. It's a gift card. It's a refundable credit, and you may apply if you're 64 years of age or older, and you owned and occupied a principal residence in Ontario that you paid for or someone paid for on your behalf. You must apply for it. But again, if you have tax software, it's going to be prompted on the tax software. If you go to Uncle Harry or the guy in the mall or the guy or gal in the mall or to a nonprofit tax clinic of various sorts through a social services agency, all of them know about this and will apply, make sure it goes on the tax form separately in order that you would get this. Next slide, please. So the OTB, the Ontario Trillium Benefit, and the Seniors Homeowners Property Tax Credit, you apply by completing and attaching the Ontario Benefit Reform. Remember, this is automatic in the only. We're only worried here about people who are still filling out tax forms on their own and not using a paid service, an unpaid volunteer service, or any tax software. You will be prompted to fill out these. You do not need to apply for the Ontario Sales Tax Credit because it's done as part of your return, and you may be eligible for both the Ontario Trillium Benefit and the Senior Homeowners Property Tax Grant. But again, they will be asking you questions on the software that a lot of people use now. This slide mostly applies to people who are filling out the old tax form, the one that you got at the post office in not too many years ago, but we've gone through a major transition in the last while. Next slide, please. So again, looking at these, the OTB and the Ontario Seniors Homeowners Grant, we're seeing that if you had a spouse in 2023, and now I'd be asking the question, did you have a spouse in 2024? If you're married on December 31st, 2023, the same spouse has to apply for the OTB and the Ontario Seniors Homeowners Property Grants for both of you. If only one spouse or common law partner is 64 years of age or older, and now change that to December 31st, 2024, that spouse has to apply for these credits and the grant for both of you. Okay, so you're only going to get one for the two of you, basically speaking. Next slide, please. If you and your spouse occupied separate principal residences, and you have to be in a situation that you applied for separable principal residence for medical reasons, means that you are involuntarily separated. Okay, and so for next year's taxes, then the date will be December 31st, 2024. You can apply for the Ontario Energy and Property Tax Credit, the Northern Ontario Credit, and the Ontario Senior Homeowners Grant. But again, you have to be involuntarily separated, which means that, it's a situation where you cannot take care of your spouse and he or she is possibly going to be in long-term care or a home or assisted living. And then you need to make sure in that particular situation, if you're involuntarily separated because you don't like each other anymore, this is not a situation that would apply in this particular situation. Next slide, please. So not too many gift cards for seniors, and they're valuable. They're good. And I didn't mention the climate one. The climate action keeps changing. It's one of the few that isn't income tested, and so. If you've been watching the proceedings of Parliament over the last while, you know that the money that the government was going to provide to checks for or payments to all working Canadians, there was quite a bit of backlash about that. That money, I presume, would have been paid as a refundable credit. They would have used the tax system to make those payments. Mr. Ford in Ontario is thinking of giving money to all Ontarians in the new year, and we'll have to see how that will work. But again, because we have a tax system and because everybody's registered, or most people are registered in the tax system, it's quite likely that any benefits like that would in some way, shape, or form use the tax system to distribute them, because it's a system that's already in place. You wouldn't create a whole new system to do that. So that's important. So finally, we come to the very few deductions. Now, what's a deduction again? It's money off your income. So if you make $40,000 and you have $1,000 deduction, then you're reporting $39,000 in income. If you make $90,000 and you have a $10,000 deduction, then the income you're reporting is $80,000. And that's all done on the tax form. So it's an amount, it's a particular mechanism to reduce your income, which will in turn reduce your taxes, but it will reduce your taxes at your tax rate. So the nominal value of the deduction, as I used in the example of the RRSP, a $10,000 deduction could be worth $5,000, it could be worth $2,000, it could be worth nothing. So it's important to understand that the deduction is worth. And again, going back to the store, if you were to hand in a coupon that acted like a deduction in the store, the cashier would have to ask you what your tax rate is in order. And you'd say, why do you need to know my tax rate? The cashier, being smart in all these taxation matters, would say to you, because I don't know the value of the coupon until you tell me what your tax rate is. So that's how a deduction is different from a non-refundable credit. So let's go through some of them. Next slide, please. The disability support deduction. So this means it's a deduction from your taxable income. Let's say your taxable income is $50,000. The value of the deduction reduces your income that you report. So supports that are purchased for the purpose of employment or education is deductible, such as sign language interpretation services, real-time captioning, deaf-blind intervention services, TTY and other teletypewriters, optical scanners, and electronic speech synthesizers. So the ports that the valid ones that you support, that you purchase, results in a deduction. In other words, it comes off your income. Let's say your income is really low and not taxable. The deduction is worthless. If you have higher income, it's going to be worth more. If you have really high income, it's going to be worth even more. Next slide, please. So that disability support deduction, the maximum amount if for employment to be claimed is lesser of the total expenses you paid in the year to the extent that they were not reimbursed. So for example, if you have a provider, you have a health plan of something that will pay a certain amount of those, then it's only the amount that is that they didn't pay for and the amount of income you earn from work or business. Different maximums are used for education. Okay. Disability supports are 100% deductible versus the medical expense credit. Deduction lowers net income and may make it easier to qualify for certain social assistance payments. Okay, so it takes your income down, the income that you report, and therefore it may make you eligible for other things. Just like if you take an RRSP out between 65 and 71, it will lower your income and therefore result in more GIS. So the hydraulics of these systems, how they all work with each other, is different than a non-refundable credit, for example, that can only reduce the amount of your taxation. It can't do other things. A deduction can. Next slide, please. The attendant care expenses deduction. Attendant care expenses can only be claimed for amounts paid to an attendant who is not your spouse. Again, the government is very much getting away from taking normal care, shall we say, and providing tax credits for that. Attendant care costs can be claimed for persons who are eligible for the disability amount, in other words, that disability credit, and in some situations for persons who do not qualify for the disability amount. So it's not contingent on being able to get the disability tax credit. Must have receipts from the attendant with the attendant's social insurance number included, but you or your spouse can claim amounts paid by you to care for you, your spouse, a dependent child under 8, and a dependent child over 18, a parent, a grandparent, brother, sister, aunt, uncle, niece, or nephew. But remember, it's taking, you can only be claimed for amounts paid to an attendant. You can't pay your spouse to do this and then deduct it. So it's providing to people who would be not part of your very immediate family, like your spouse. Next slide, please. And here, the situation where it's paid to a retirement home for seniors who are eligible to claim the disability amount. Attendant care expenses paid to the retirement home may be claimed as a medical expense. Okay, so you often have situations like this where an attendant will be in a retirement home. I've seen it up close and personal myself. There's lots of attendants who go into various forms of retirement homes and LTC, and you see an eligible attendant care costs include the salaries and wages of the employment of the retirement home when they do it, health care, housekeeping for the residents' individual living space, laundry service for the residents' personal laundry, transportation services, and secured units. Really important here. This is the one place that I would say that you really have to go to to an independent tax advisor if you're doing it. If Uncle Harry is doing it, then Uncle Harry is really going to have to know this. In other words, what I mean is a family member who is doing your taxes for you, or somebody who does taxes for everyone. I use the term Uncle Harry because I was advising a low-income woman years ago about her low-income retirement situation, and she pointed out to me that her Uncle Harry did her taxes each year, and she said, "Well, Uncle Harry really knows a lot about taxes." Uncle Harry may know a lot about taxes, but does Uncle Harry know all about all the different benefits and all the different aspects of low income retirement and all the various different? I only say that here because this is one of the really difficult ones. I found that this is the real benefit of getting an individual tax advisor who's is an expert in this area. They sometimes will have the home actually completely redo their expenses for the purposes of making sure that the person gets the best deal on their taxes. So you really have to have those bills divided up in a way that show the eligible attendant care costs. Do all retirement homes do it? They sure don't. And I've seen it over and over again. So doesn't mean that some don't do it right. There's some that do it carefully, but the home may be much more concerned in terms of their billing and that sort of thing. They're not necessarily thinking about how that someone who is working in the home it has the facility of having the eligible attendant care costs. Next slide, please. So here's the situation. My brothers, Mark and Alex, we share a house. In April 2024, the brothers paid $4,000 for the supply and installation of a share lift. The brothers paid $6,500 for some. The total of the eligible expenses is $10,500. So this is a situation, because it's not a spouse, that you could get that eligible expense as a deduction. Next slide, please. And there we are at 2:40. So we got 19 long minutes to take in questions, answers, and clarifications. And I generally find that we usually have about 20 minutes left after doing the presentation. So that's good.
Okay. Well, can you do about 20-second answers? We have a lot.
We got a lot of questions, yeah.
Here's one that's just related and come in about if you have an adult child with a mental illness who's seen a psychologist, can a medical expense be claimed?
Yeah, that may be an eligible expense. And again, you're trying to look at uh, in terms of how you claim it and how you're paying it, and you have to look at how much money are you actually paying in the first place for it. Is it covered in any other place, whether it's through a private or a public insurer? You're only going to be eligible for an expense that's over and above, in other words, that you paid out of pocket for something like that. And this is exactly when I tell, this is where you're trying to talk to someone. I would take an independent advisor to see where those are eligible.
Yeah, good question. Or good.
And again, how far are you going to get this service? Are you going outside of it? I mean, there's lots of things that we have to pay for that are medical expenses that we have to pay for out of pocket. They're not all covered under our health insurance plan. But how far do you have to go to get it? What else does it involve? And again, that's when you have to go through the gamut of all the things I just presented to you since 1 p.m. and say, okay, which one would make the most sense?
Okay, thank you. So we talked about this briefly at break, but the notice of assessment question, it indicates that the person can claim their disability tax credit from when they were disabled in 1997 to 2000.
Go for it.
Go for it. That was less than 20 seconds.
Fill out the DTC application. It's complicated. You may need some help doing it. And of course, then you're going to have to get it to a doctor, an attending physician, or a nurse practitioner. You may have to pay for it to be done if you don't have your own doctor. If your doctor, in some cases, will have fees for doing something like that. And this is the point where I'm going to say doctors and nurse practitioners get pressed to, because there's a valuable tax credit here to find the person to be disabled. The Canada Revenue Agency is quite strict. And doctors and nurse practitioners have lost their license for making people saying that people are disabled who they later decide who are not. So the doctors and the nurse practitioners are really careful. I say it too, especially because we're talking about a time in the past. So the records are going to have to be awfully good. But if CRA is telling you that you were already eligible at that time, but didn't have the assessment, you have to really get the wording on the notice of assessment. Are they saying may, or are they saying you are eligible? If you are eligible and you got all the paperwork done, then just tell them to redo your taxes for those years.
Here's a quick question. I don't know if it's a quick answer, but does tax software generally pick up all of these different credits? Will it flag people that they may be eligible?
Generally speaking, when you put on, say, TurboTax, the one I'm familiar with because it's the biggest, if you were to you put apply as a disabled person, like in other words, put down the DTC, then it's going to take you through all of them. What I'd worry about is if you weren't applying and you didn't put down, you tick the box for the disability, that you're a person reporting your taxes as a person with a disability. And you can have a disability. I mean, you can be on ODSP very easily and not qualify for the disability tax credit. In fact, most ODSP recipients do not qualify for the disability tax credit because there's a very different definition of disability. If somebody doesn't want to either go further afield and talk to a volunteer or a paid professional of some sort, I wouldn't take this one to the mall, to the people at the mall, but because you're not going to get that level of expertise or care. What I would do is take TurboTax and go right through it, saying that you're a person with a disability tax credit, and then see where it takes you, because it's pretty good. The tax software is pretty good if you identify as a person with a disability. So you could do a sample return and see all the places that return takes you, but not necessarily file that claim. If you see what I mean, but if you report as a person with a disability, it'll take you to all of those things. But if you don't report having the DTC, it may not take you there as part of that. But it usually takes you everywhere else. But I wouldn't trust it to take you everywhere in terms of all those different elements. I'd be getting in touch with CRA to see or going online to various forums and that sort of thing to make sure if you're eligible for it. I'm also here to tell you that all government forms are not online. One of the famous ones is the GIS statement of income, where you might be making an election to have 1 year to have your GIS calculated on the current year rather than your previous year. You can do that. Is that form online? Nope. So something that you have to go and get. So again,
you're first.
The reason I'm saying all this is, I mean, there's good independent tax advice out there. And if you need that advice, it's sometimes worth just getting your credit card or your checkbook out and paying for it. You often only have to pay for it once, and then it carries on through other years, right? Because you've already done the work that you needed to do to get the credit that you needed. So you might think about doing that. And again, low income people, if you're not the only suite of these credits of this presentation that apply to you are the refundable credits. So all those other things, like the deductions and the non-refundable credits, are only for people who are paying tax. If they're paying tax, it means they're at a certain level of income. And at that higher level of income, they might want to take some of their discretionary income and go to an independent tax advisor and pay them.
Okay. So this is a two-parter. Somebody was asking for a reminder of transferable tax credit, and is $1,500 a year called a transferable tax credit?
Well, there's various different transferable ones. I think I covered them all as we go, the age credit and the spousal credit, and especially the disability tax credit. If you can't use it, then you can, and you actually, with the disability tax credit, you can transfer it to an attendant. But they're all quite specific of where they're transferable and who it's transferable. So I think going through the presentation, you can create for yourself a full list of the ones that are transferable. Others simply are not. Your refundable credits are not transferable, for example. And with the refundable credits, if you're married, they're going to say, okay, one spouse is going to get these. And so decide amongst yourselves who gets it. For the medical expense non-refundable tax credits, you're always better off to take the lower income spouse. So when CRA gives you a choice, if they give you a fork in the road, then take it. This is I mean, the point is they're all different. So if I were to sit and actually do an inventory of all the different transferable credits and the conditions under which they are transferable, then I'm almost redoing the presentation for you again. So it's good to simply take it and work through it, because they are different.
It is a good reminder that the decks will be shared after each session. This is our last session. So if you missed any, please let us know. And that you have the companion document that you've created to these series on your website. Somebody's actually just given a comment. So much information, need to review it all again before taxes. So completely agree. So the next one is, can you claim parking expenses for visiting your spouse while they're in hospital?
No. Generally speaking. Now, is the hospital more than 40 kilometers away?
Good question. Don't know.
Then you could put them in. Yeah.
Okay.
But remember, the hospital has to be, it's the only place you can get that care. Okay, so if your spouse is in the hospital and it's 40 kilometers away, but that was just that you made a choice not to go to a hospital that's closer, then it wouldn't be. So again, where this is most usable is for people who are in more rural environments or in small towns. That's where this really applies the most, because people often have to go further because there is no hospital or there's no treatment center. Once again, as I mentioned earlier, if you're in a if you're in a city, if you're in York Region, I think you'd have a hard time saying not only saying you went to a particular hospital, but it was the only place you could get the care. But if you do that, then you can do the mileage and take the parking expenses and include them.
That's so helpful. I think this person might have missed and could be referred back to the slides. Is attendant care considered medical expense and thus a tax credit or tax deduction?
Well, there's an attendant care tax deduction, yeah, and as long as it can't be your spouse that you're giving the attendant care to, but another family member. And again, the big change over previous years is that you don't have to be living with the person to do that and charge the attendant care. And if the attendant care is in a home where the person lives, then it gets trickier. You have to really separate out the various different expenses that the home is charging. Now, often people, I've noticed that people will just get a bill, and in a fancy home, you might be paying, $5,000, $6,000, $7,000, $8,000 a month. It's not unheard of, and but the bill might just come with meals and services, and I've seen that. And then your very clever tax advisor will be saying, take this bill back and have them itemize out the attendant care if in fact you had attendant care within the in the care setting. But if you're at home and you're doing it, you don't have to live with the person and you can get that deduction.
Thank you. There is a question that came in that may not relate to disability tax credits so much as, can you discuss non-taxable mutual funds versus a TFSA? I think you might have a session to refer someone to.
Non-taxable mutual funds. Now, I can't think of a situation where money in a mutual fund, if it gains, where it would not be considered a taxable gain. There are certain types of bonds that are non-taxable bonds that could be in a bond-related mutual fund, which are not taxable. But in a sense where what the comparison urges me to do is to compare apples with oranges. TFSA is a tax vehicle. It's a registered tax vehicle. An RRSP is a tax vehicle. In other words, it's a repository that you put certain forms of money into. Okay, so a mutual fund is a certain type of security. And you can put that mutual fund into a TFSA. You could put it in an RESP. You could put it into a self-administered RSP. So in other words, you're talking about, I use the analogy in the presentation of the plate and a meal plate, and the TFSA meal plate and the RRSP meal plate. Well, each of those registered vehicles can have different types of investments inside them. So in a sense, the mutual fund is one of the ingredients on the plate, one of the items on the plate, as opposed to being it itself. Generally speaking, people would try to put in TFSA and RSPs investments that would normally be taxable because they're not taxed inside the plan. So often people would put in GICs or interest-bearing accounts or stocks and bonds that would otherwise attract capital gains tax. You put them inside the registered vehicle so they don't do that. Of course, when you take them out of a TFSA, you don't pay any tax on them, whereas an RSP you would. So if your TFSA goes to the moon, if you bought NVIDIA stock or Tesla, 8 years ago, and now that's what's in your TFSA. Then when you take it out, it's all tax free, even if you have millions of dollars in there. Like there's newspapers articles on this actually all the time of people saying somebody's got $2 million in their TFSA, and is that legal? Well, yeah, but you have to grow it from the amount that you were originally allowed to put in. So you put in your 90,000 or close to $100,000 now next year into TFSA, and then your junior gold stock hits the mother lode, and the stock goes up 10 times. Then all of that money, when you take it out, is not taxable.
John, we're nearing the end, so I'm going to ask a question that's come up a few times. So I hope the person who asked the question, because it was anonymous, they asked about regarding an LIF and an RRIF and how to leave it for their grandchildren, the best way to be able to pass it on to their grandchildren.
Well, the usual way is what happens when you pass away. Your registered funds are crystallized at that point. I think that's the term they use. In other words, the value in them, and then you pay tax. Anybody who passes away has a tax return in the current year, and then they have another tax return to do, which is called the final return. And then the money that's in those particular accounts will be taxed. CRA will want their tax first, and then the amount that's left over goes to the estate, and the estate can pass them on to whomever the person has willed themselves to. So if in this case where it's grandchildren, then those amounts get crystallized, and then it could go on to the designated heirs in that case. Now, if somebody wants to give money from a registered instrument during their lifetime, then they have somewhat the same issue that they have to take it out at that time and do it. I wouldn't advise it, because if it's a lot of money, especially in a RIF or a LIF, lifetime annuity, when you take it out, it all becomes taxable that year, and you balloon your taxes. And I think, and then you have to make, and then you can only pass on the amount of money that's left over after taxation has taken place. So it's better in situations like that where the money's locked in, is to simply designate who your heirs are, and then your executor at the time of your passing will pay the taxes on the various accounts, and then what's left over would get paid to the designated heirs.
So, John, we're at 3.
Yeah.
I don't know if you might have 10 extra minutes if we were to go over for just a moment.
Sure.
I want to make sure that for those who need to step away, that we just give you a big thank you. You've not been seeing the Q&As, but you've been certainly receiving lots of accolades for your knowledge, and thank you so much for sharing. This has been the most incredible 5 weeks spent with you. We've had the benefit of lots of discussions, so thank you so much. And just a reminder, as on the slide, your booklet is available, and we will be sending that with the link to with the decks. And also, when the video recordings are available after the series is finished and we've had time to put them together and send them for posting, we will certainly send an email to all participants so that people can access it. Before we sort of do the extra 10, 15 minutes, did you want to give any parting words for those who have to part right now?
Yeah, the one thing is that I always ask, and I ask it at the libraries too, and I said, if you find out anything that I have said that you can certify to be incorrect, in other words, you receive relevant or credential tax advice that I've said something that's either misemphasized or incorrect, or if there is a new amount that you find for something, because the amounts are changing all the time and these benefit plans are changing all the time. They're very, very hard to keep up with if you're just one person and you're trying to keep up with every non-refundable credit, every refundable credit, every tax deduction, etc. I don't doubt that people will find from time to time that there is something that's either misemphasized or there's a new amount or a change has been made that I didn't hear about. So don't be silent. Get in touch and say and let us know so that we can improve the quality of the presentations.
All part of the solution, right?
Yeah.
So I also just posted a poll. I don't know if you can see. It's just to ask folks that are participating today if they learned something that was helpful today and if they're going to use what they learned today to help support themselves or someone else in the future. So we'd value if you can just take a moment to fill that out. And importantly, how did you hear about this session? If you could let us know about that too. So while people are doing that, John, I'm going to go back to the Q&A, if that's okay. And this is the bonus round.
Bonus round. Yeah.
Game. We'll stop at 3:15, but we'll get a few more questions in because there were so many. And thank you for offering to do that with us. So let's see. I think you answered this, but let's just be sure. Is there a line for attendant care in the tax forms?
Yes. Now, when you say there's a bit of a catch there, because if you go into any of the tax softwares, the various different ones, they make reference to all of the different government forms. And of course, as they take you through your tax return, they're not necessarily going to canvass every single government form as you go through that. So they do it. They have their artificial intelligence. They have the various questions that they've asked you. They're not necessarily going to catch the one that you did. So, but I do know that TurboTax and others has little Q&As, like a place where you can ask a question or post and that sort of thing. And what I've noticed that if you were to type in something like attendant care or attendant fees or etc., it will bring up a particular set of forms, maybe one or more that relate to that. And then when those form comes up, there'll be a Q&A. Like going through each of the softwares, there's two ways you can do it. You can either do it so they interrogate you as a question and answer session, or if you're fluent with the forms, you can go directly to the forms and fill them out yourselves in the software. When you do it on your own, it's like you're telling the software company, I know what I'm doing. If you go through the Q&A, then it's like saying they're questioning you and then coming up with. So are they there? Yes. Will you always be prompted to use them? That would be much more difficult. You'd have to somehow let them know that you're applying in this particular situation. Put in attendant care, then it'll bring up the relevant form and then you can fill it out. Now that's how TurboTax works. Now, do they all work like that? I'm not sure.
Okay. Another person said, let's see, I was asked to return a total of $3,000 for 2 years' expenses after supporting my husband during his stay at long-term, I'm guessing care.
Yeah, long-term care.
Purchasing personal items. I guess it's a statement more than a question.
Yeah.
Okay. Apologies. Okay. Next.
Yeah, CRA will do that. Like if they think you've listed something that's not medical in nature, they're not going to. Like personal items.
Why do we not have an exemption to those who miss cashing investments before turning 71 due to very serious situations instead of turning them into LIF or RRIFs?
Okay, can you start the first part of that question again? Why is there?
They're wondering why there is not an exemption for someone who missed cashing investments before turning 71. They must have had a very serious situation that they were not able to do. and was not able to turn them into a LIF or a RIF.
So this is a situation now. So this is not an RRSP situation, which is what I was trying to elicit here. Here's a situation where this money that someone has outside of a registered instrument, and then has, I think, lost money as a result, or has had to use it as
No, if they're
expenses.
still on, maybe they could offer that clarification in the Q&A.
Yeah, because there's really it could result in so many different answers.
Okay.
You know, but the reality is we have very few income exemptions in our system anymore. And the exemptions, and we don't have any formal exemptions. We just have money that CRA does not want to know about. If you sell your car to somebody, you don't report it as income, right? If somebody has a book and you've read it and they want to read it and they say, well, I'll lend it to you. And they say, no, I'd like to buy it off you. I mean, well, you don't count that $10 in your or $20 on your income tax form, right? If you win money at a bingo or racetrack, lottery, none of it, they don't want to know about it. So it seems to me, so it wouldn't be an exemption in this case. You're talking money that somehow was made taxable and was not allowed to be sheltered because it wasn't in a registered instrument of some kind, and then people lost money on it. I mean, that's as far as I can get with the question. I will tell you, it brings up an important issue with TFSA. So if you say, I'd never put money in a TFSA, and tomorrow you put $100,000 into a TFSA, you know, coming into 2025 when that will be the ceiling. And let's say you go out and buy a penny stock, and then the penny stock is delisted because it's not worth anything, or you know, the gold mine they thought they had end up being fool's gold or something. Then you don't get your TFSA room back. You lost out. So because if your investment loses money, is a perfect example where you that's it, you're done.
It's like you can't hop into your TARDIS and go back in time and fix it. Yeah.
No, not
Doctor Who
that
reference.
occasion.
So another question that came in was, how do we define? Oh, sorry, that's not the question. I think you answered this already too, about what is the GAIN program. So I think we would have people go back to your original.
Well, remember the GAINS program is a program. The chief thing to say about GAINS is that you can't apply for it. You apply for GIS, and if you get a certain level of GIS, the Ontario government will automatically sign you up and pay you the GAINS program. So don't worry about losing out. What you need to lose out and make sure you don't tick the box on the old age security form, let them figure out whether you're eligible for GIS, and then they'll tell you whether you're eligible for GAINS. That's a very, very frequent question. People say, where can I apply for GAINS? And the answer is that you can't.
An oldie but goodie question from TFSAs. Why is the TFSA not good for middle income people?
Hey, it's not that it's not good. It's just that you should be going into an RRSP first if you're middle income. Why should you be going to RRSP is because you're making good money, you're middle income, you're earning, you're paying taxes. I'm going to make that assumption that you're making enough income to pay taxes. And with the RRSP, you get a deduction, and that deduction will be worth money to you. And so if you have RRSP room, why not put it into an RRSP and then take out that TFSA later? If you're middle income, you're not going to be eligible for GIS. You see, and therefore the money is simply will be taxed at a lower rate when the money comes out, either if you take it out of your RRSP or wait for it to RIF and then come out first slowly and then more quickly later. So that's where you would, first of all, think of putting your money if you're middle income. The TFSA, of course, for people who have lower income before they retire and then have higher income and much more taxable income after age 65, that's where they should put their money, not just for the issue of potential taxation if they have enough to pay tax in the first place, but because they'll have a clawback on their GIS and the TFSA, you take money out and nothing happens. The other thing that happens is nothing in particular happens at age 71 with the TFSA. It stays a TFSA till the end of your time here. And for very high income people will make an assumption that they've already maxed out their RRSPs. So it's a great way to have a tax savings vehicle to put your money. When TFSAs first came out, there was widespread view that the TFSAs were good for rich people who had already maxed out their RRSPs. And I think there was a number of us saying, no, this is a really good program for low-income people to save if they are able to save and have money that they can put aside.
Yeah, this will be our last question. And you heard it at break and you started to answer, and then we thought we would wait to do it at the end. A person said they're 71 years of age, still working, turned 71, and it was mandatory that they receive the pension plan from their employer, withdrawal, a certain percentage of their RIF, and also they were receiving CPP and OAS. They didn't qualify for GIS. Wondered if there was a way to minimize their taxes. Now that's a big mouthful to end with, isn't it?
Yeah, and see, this is a situation that it's not just peculiar to this person. It happens with everybody. So the person asking the question can be quite secure, and it's not just happening to them. It's going to happen to all of us. If you turn 71 and you're still here and you have any form of pension plan, it's going to be paid out, and especially if you're put into a group RRSP, any form of money that your employer could have said to you, part of working here is you pay into the group RRSP and they'll pay some additional amount or maybe no amount, but part of the deal is you're in this plan. Well, of course, that's going to riff out at age 71, and then you're going to have to pay tax on it. So is there any way of avoiding tax on a RIF? And the answer is, I don't think anybody's found one yet. That's how the government gets its money back from RRSPs. And the whole reason behind that is that they gave you a deduction when you put it in. So now you have to pay the piper on the way out. They're going to want that. Now, what happens to a lot of people is that they're making more money in retirement. And I think this is a special situation in this questioner. Why? Because he or she is still working, right? And so still making money and also now getting OAS and CPP, which are both taxable, which are going to take earnings are taxable. So that's on top of that. And there's a lot of people who are in situations that say, hey, the deduction I got 35 years ago is nowhere near the amount of money I'm paying in my RIF now that's come out. But who signed me up for this? Well, in this case, it looks like it was a person's employer, and that's part of, if they say this is our plan, if you work here, then they can do that. And if you signed up and self-administer your own RRSP, then you thought you were going to make less when you were older, and you ended up paying more when you were older because you kept working. Now, RRSPs were brought in 1957, and we didn't get the abolition of mandatory retirement until 2006. So there was a general rule that people were always going to do better through the deduction of the RRSP, and then they were going to do better because their taxable income was going to be less later on. Well, what happens if you're 71 and you got a good job? Then the amount of that deduction way way back long ago is not near what the amount you're going to have to pay in tax. And that's just policy changed. 1957, no one even conceived of the abolition of mandatory retirement.
John, you know how I'm going to end? I'm going to read what somebody's put as a comment because couldn't agree more. I've had the good fortune of attending all of John's sessions and am amazed, capitalized, at his depth and breadth of knowledge, also his compassion and care for seniors, and especially for his interest on immigrants. It comes through all of his presentations. So a huge thank you to you, John, and to York Region for hosting these sessions. So what a lovely way to end the session.
Yeah, we can't do better than that.
No. So thank you, everybody, for attending. And for those who stayed a bit later, hope you had most of your questions, if not all of them, answered. And we look forward to sharing the decks and eventually the recordings. Stay safe and well over the holidays. Have a great day, everyone.